It's a random Tuesday evening. You're scrolling your phone, and you see it again. Someone your age, talking about their investment portfolio, passive income, compound growth, numbers that make your current bank account feel like a joke. And you think, okay, I need to start. So you open Google. How to invest for beginners. 47 tabs later, you know less than when you started. Stocks, bonds, ETFs, index funds, mutual funds, brokerage accounts, Roth IRA, 401k dividend investing, value investing, growth investing, technical analysis, fundamental analysis, and somewhere between tab 23 and tab 31, you close everything, put your phone down, and tell yourself, maybe next month. Sound familiar? Here's the thing. That's not a you problem. That's an information problem. Because the investing world has a habit of making simple things sound incredibly complicated. And when everything sounds complicated, most people do nothing. And doing nothing is the most expensive mistake you can make. My name is Jack. If you've been meaning to start investing but keep finding reasons to wait, this video is going to fix that today. Hit subscribe and give this a thumbs up because what I'm about to show you is the exact path I would follow if I had to start from absolute zero. No jargon, no confusion, just the actual steps in the right order. Let's start with the thing nobody tells beginners. Investing is not complicated. It has been made complicated. There's an entire industry and advisors, platforms, content creators, financial media that benefits from you believing investing is complex. Because complexity creates dependency. If you think you need an expert to invest, you'll pay for one. But here's what most people don't realize. The simplest investing strategy has historically outperformed most complicated ones. Let me say that again. Simple beats complicated, almost every time. Warren Buffett, arguably the greatest investor in history, has said repeatedly that most people should just invest in a low-cost index fund and leave it alone. Not options trading, not picking individual stocks, not timing the market, just an index fund. And time. So if the world's greatest investor is telling you to keep it simple, maybe we should listen. But before we get to the how, we need to talk about the why. Because most people try to learn investing before they understand what investing actually does for them. And that's like trying to learn how to drive before you understand where you're going. Here's what investing actually is. Right now, your money is probably sitting in a savings account. And that's not bad. Savings accounts protect your money. But they don't grow it. Not meaningfully. At 1% interest, $10,000 in a savings account grows to roughly $2,100 after 1 year. That's $100. Meanwhile, the S&P 500, which tracks 500 of the largest companies in the United States, has returned an average of about 10% per year historically over long periods. That same $10,000 invested in an S&P 500 index fund, after 1 year, $11,000. Same money. Completely different outcome. But here's where it gets really interesting. That difference of $900 in year one sounds nice, but it's not the point. The point is what happens when you leave it alone. Let's look at 30 years. $10,000 in a savings account at 1%. After 30 years, you have about $13,500. $10,000 invested at 10% annually. After 30 years, you have about $174,000. Same $10,000, completely different life. That difference? That's compounding. And compounding is the single most powerful force in personal finance. Albert Einstein reportedly called it the eighth wonder of the world. Whether he actually said that or not, the math speaks for itself. Here's the kicker though. Compounding only works if you give it time, which means the single most important thing about investing is not which stock you pick. It's not which platform you use. It's not even how much you invest. It's when you start. Every year you wait is a year compounding loses, and you can never get those years back. Okay, so now you understand why. Let's talk about the exact steps I would follow if I were starting from zero today. Step 1. Handle one thing before you invest a single dollar. Before you open a brokerage account. Before you research a single stock. Before you do anything, you need one thing in place. An emergency fund? I know, not the exciting answer. But here's why it matters more than people realize. The biggest reason beginner investors lose money isn't a bad stock pick. It's life. Something unexpected happens, a car repair, a medical bill, a job change. And suddenly, they need cash. So they sell their investments, usually at the worst time. Usually at a loss. An emergency fund is what prevents that. Think of it as the bodyguard of your investments. It stands between your portfolio and your panic. You don't need a perfect emergency fund before you start, but you need something. Even $500 to $1,000 saved. Separately before you invest, your first dollar will protect you from making emotional decisions when life gets inconvenient, which it will. Step 2. Understand what you're actually investing in. You don't need to become a financial expert, but you need to understand the two most important concepts before you put in a single dollar. Concept 1. Stocks. When you buy a stock, you're buying a small piece of ownership in a company. If the company grows, your piece becomes more valuable. If the company shrinks, your piece loses value. Simple. Concept 2. Index funds. Here's the problem with buying individual stocks as a beginner. You have to pick the right company. And most professional fund managers, people who do this full-time, fail to consistently pick stocks that beat the overall market. So what chance does a beginner have? An index fund solves this problem elegantly. Instead of picking one company, you buy a tiny piece of hundreds or thousands of companies at once. When you invest in an S&P 500 index fund, you're investing in 500 of the largest U.S. companies simultaneously. Apple, Microsoft, Amazon, Google, all in one investment. You're not betting on one company, you're betting on the entire economy. And historically, the economy has always gone up over long periods. This is why index funds are the starting point for most smart investors. Low cost, diversified, simple, and historically very effective. Step 3. Choose a platform and open an account. This is where most people overthink it. They spend weeks comparing platforms and never actually start. Here's what actually matters when picking a platform. 3 things only. 1. No minimum investment. Some platforms let you start with $1. Others require $1,000 or more. As a beginner, start somewhere with no minimum so the barrier is as low as possible. 2. Low fees. Some platforms charge commissions on every trade. Many don't anymore. Always look for zero commission trading. 3. A simple interface. You don't need every tool available. You need something you can actually understand and use. Popular options that check these boxes, Fidelity, Charles Schwab, and Vanguard are consistently recommended for beginners. Do your own research and pick the one that feels most intuitive to you. Opening an account takes about 15 minutes. It's basically a bank account for investments. You'll need your ID, social security number, and bank account details to link for transfers. That's it. Step 4. Make your first investment. Here's exactly what I would buy if I were starting from zero today. A broad market index fund. Specifically, something that tracks the S&P 500 or the total US stock market. On most platforms, you'll find options like VOO, VTI, or FXAIX. These are all low-cost index funds that give you exposure to hundreds of companies in one purchase. Don't overthink the choice between them. They're all solid starting points. The difference between VOO and VTI is far less important than the difference between investing and not investing. Start with whatever amount you have. 50, 100, 500. The amount matters far less than the habit. Because here's what most people don't realize. Your first investment is not about the money. It's about crossing the line from someone who wants to invest, to someone who invests. That identity shift is worth more than the return on your first $100. Step 5. Set up automatic investing and ignore the noise. This is where most beginner investors fail. Not in picking the wrong investment. In reacting to the market, markets go up, markets go down. Sometimes dramatically. In 2020, the market dropped nearly 34% in about a month, then recovered completely and hit all-time highs by the end of the year. People who panicked and sold in March 2020 locked in their losses. People who stayed invested recovered everything and more. The strategy that removes emotion from investing is automation.
Set up a recurring investment, whatever you can afford.
Monthly, $50, $100, $200. It gets automatically transferred and invested on a schedule. You don't decide every month. You decided once. The system handles the rest. This is called dollar cost averaging. And it works because you're buying consistently, at high prices sometimes, at low prices sometimes, and which averages out over time. Market crashes become buying opportunities. Market highs become portfolio growth. Either way, you're in the game. Let me give you a quick real example of what this looks like in practice. Imagine someone, let's call him Marcus, who starts investing at 25 with just $100 a month into an S&P 500 index fund. He doesn't pick stocks. He doesn't watch CNBC. He doesn't panic when the market drops. He just invests $100 every month for 35 years. At an average 10% annual return by age 60, Marcus has invested $42,000 of his own money, but his portfolio worth roughly $380,000. He didn't get lucky. He didn't pick the next Apple. He didn't time the market. He just started and stayed consistent. Same strategy available to everyone watching this video, right now, today. So let's bring this together. If I had to start investing from absolute zero, here's exactly what I'd do. First, Build a small emergency buffer of $500 to $1,000 before investing a single dollar. Protect your investments from your life. Second, understand that you're not picking stocks. You're buying index funds that own hundreds of companies at once. Simple and diversified. Third, open an account on a no-fee, no-minimum platform. Takes 15 minutes. Don't let this step stop you. Fourth, make your first investment in a broad market index fund. Any amount. Today, cross the line. Fifth, automate monthly contributions and ignore short-term market noise. Let compounding do the work. Because here's the truth most people never act on. The best time to start investing was 10 years ago. The second best time is today. Not next month when you feel more ready. Not next year when you have more saved. Today. With whatever you have. Because the market doesn't care when you feel ready. Compounding doesn't wait for the perfect moment. And the people who build real wealth aren't smarter than you. They're not luckier. They just started earlier and stayed consistent longer. That's the whole secret. So here's your challenge. This week, open one account. Transfer whatever amount feels comfortable. Make one investment. Don't wait for permission. Don't wait until you understand everything. You'll never understand everything. Nobody does. Just start. Then come to the comments and tell me, what's stopping you from making your first investment? Because I read every comment. And I think when you say it out loud, you'll realize the answer isn't as complicated as you thought. Hit subscribe if this helped. Because on this channel, we don't make investing sound impressive. We make it actually doable. See you in the next one.